Stop this. Thank you for being with us here today. I'm speaking from Rye, New York, and Peter, you are, I believe, in Vancouver.
That's correct, Danny.
Great. So, wow. So for you, it's 3 hours back. All right. Got it. So very good morning for you. And I want to read a couple of words about yourself, especially what I think was interesting when we spoke yesterday, and I'm not sure how much we stressed that in our invitation. Your firm, the firm you work for, is the firm that advises the, I believe, Canadian institutional investors regarding infrastructure deals and funds and everything around that. So I think this is a very interesting point to mention. So just a couple of words. My guest today, Peter Mordue, is a managing partner, is an experienced infrastructure investment professional with over 15 years of experience in the infrastructure space. Worked on multi-billion-dollar infrastructure equity transactions, led infrastructure debt, secured mezzanine and preferred equity transactions, and expanded, launched, and managed new infrastructure products. And today you're with Agentis, that, as I've mentioned, advises the Canadian institutional investors. And you work at Global Institutional and before that, you worked as a Global Institutional Investment Manager at IFM Investors. Agentis itself, a boutique infrastructure advisory firm that is based, I believe, in Toronto.
Yeah, it's got offices in Vancouver, Toronto, and London, Danny.
And and today we will touch an interesting topic. I think you guys mentioned to us a very interesting co-investment opportunity that came up and you're very much excited about. You will present that to us today. So first of all, good morning to you and thank you for being here with us.
No, I appreciate it, Danny, and I'm looking forward to the opportunity to present the transaction.
Great. So let's go ahead and you can show your screen and we'll take it from there.
Sounds good. Can you see that, Danny?
Perfectly.
Perfect. Well, thank you very much, everyone, for joining. I'm going to give a bit of a preview about just Agentus as well. And then I'll delve into the specific transaction, because that's what we're all here to discuss today. So the transaction we're talking about in question is the Switch Inc. Transaction. But just before I get into that, I'll just tell you a little bit more about Agentus. So as Denny kindly mentioned, Agentus has been around for over 12 years now. It originally spun out of Macquarie Bank back in the day. And in the last 12 years, it's primarily been advising Canadian pension funds with regards to infrastructure, as well as some direct infrastructure equity funds up here in Canada. Excitingly, it was actually awarded Best Financial Advisor in North America by IJ Global last year. I've been brought on, as Denny mentioned, relatively recently from IFM Investors, where I spent over 12 years and was the CEO of their broker-dealer business, as well as portfolio manager of over $1 billion product, as well as working on other infrastructure products for IFM, which is renowned in the infrastructure space. And interestingly, is one of the joint venture partners in the opportunity that we're here to discuss today. This just gives you some idea of the team here at Agentus. We have over 20 infrastructure investment professionals that day-to-day just work on advising on infrastructure projects. This is some bios, which I won't delve into in too much detail, but hopefully you can take a look at some point. It's also interesting to note we actually have two senior advisors on an exclusive basis as well. One of them is Rob Stoner, who's the Deputy Director of MIT's Energy Initiative, Very impressive individual. And it's great to have him on board because a lot of the new innovative technology actually comes out from MIT. So we get a sort of first look of that and can sort of follow the development of those projects. We also have Andrew Fersman, who is the CEO and co-founder of 1Qubit, which was the first quantum software computing company that was set up. He's also another very impressive individual. He's done things such as advise NATO on their innovation fund, and is a great resource when you start talking about very tech-heavy subjects, including AI technology and how they can be applied to infrastructure. Delving into the actual opportunity here, I think it's maybe worth giving some background around, the competitive space in the data center market in North America, as well as what's developed over the last 12 months. So there has been a lot of growth in the data center market in North America, but it is expected to increase dramatically. That is largely driven by a trend from going from an insourcing, where you can see here in 2021, we had 139 billion or 55% of the market being insourced data centers, to more of an outsourced model, as well as the market just growing in general. And what that really means is that it's expected that there'll be a year-on-year over 20% increase in demand for data centers over the next 5 years. I might just actually quickly flick to the next slide, because what is really interesting here is you can actually look at the data center market, and we have it listed down here in the bottom left. And these are all data centers between 4.5 billion and 15 billion. And they've all been taken private in the last 12 months. And you can see when you look at the buyers here, we have, Blackstone, KKR, GIP, Stonepeak, American Towers. There's very large infrastructure equity funds. And the reason why they have taken these companies private is that they can't access the amount of money that's needed to go and capture this growth over the next 20 years as a public company. Now, Switch, the opportunity that we are talking about, that's a publicly announced joint venture between DigitalBridge and IFM to acquire Switch. It's expected that it will close at the end of July, start of August. And this is the last real data center opportunity where we're seeing them taken private. Now, there are 3 others that you could sort of throw into the mix of the cohort here. Equinix is 61 billion, however, enterprise value. There is also Digital Realty, which is, I think, 37 billion enterprise value. And so it's not really realistic, I don't think, to think that they will be able to be taken private, at least with what's happening in the market at the moment. And then there's Iron Mountain, which has an enterprise value of 16 billion. I think Iron Mountain, however, data centers, while they do run them, it's not really their core focus. So this truly is a unique opportunity to be able to get in to the data center business in North America, where size does matter, and to be able to take advantage of the growth that's going to happen over the next 5 years. So just moving back here and to sort of put those sort of companies and what they've been doing over the last sort of 12 months. You can actually see when you start looking at the revenue CAGRs of these companies, that Switch at 13.4 has actually been the standout performer. It's also excitingly 100% renewable powered. And that really is its market differentiator here. And you can see when you start looking at its return on capital and its organic growth, it is also outperforming the rest of the market. And so why this is, I think, the last opportunity to get involved in these take privates, it also, in my view at least, is with one of the standouts in the industry in North America. And so we've touched on briefly here, the competitive breakdown and what's been happening. And you can see here the expected growth as well, which is sort of showing this 20% year-on-year growth in the infrastructure space. We have some details here around the actual joint venture and what happened. The actual offer that went out was at a 15% premium to what the close was when it was announced on May 9th. And as I said, we're expecting the close will occur late July, early August. I think just to allay any concerns as well with sort of market conditions at the moment. This was a fully underwritten financed deal. So there are 4 banks that have provided underwritten debt financing for the transaction as well. And that was done at SOFR plus 250. The actual model is modeling a SOFR plus 300, just in case there is some flex and pushback from the banks, but it is fully underwritten. As far as, alignment of interest and how the equity stack stacks up here, there's 5.5 billion worth of equity in this transaction. And as we discussed, it's got an enterprise value of approximately $11 billion. And so IFM, my old employer, is putting in 2 billion of equity. DigitalBridge is putting in 3 billion of equity, and the existing CEO is rolling in for 500 million worth of equity. The actual opportunity itself is coming from DigitalBridge. And they have an interesting model that they will take these sort of large positions from time to time and then use it as a way of attracting new capital and to issue out co-investment opportunities. And that's really where we fit in. I know the folks at IFM very well and have spoken to their view on the transaction. And I know the folks at DigitalBridge exceptionally well as well. I think what is interesting is that IFM approached DigitalBridge to get in on this transaction. And DigitalBridge actually charged IFM a fee to be able to join their consortium to bid for this. What I'm being told from DigitalBridge and my friends there is that because we're seen as complementary capital and we have to do an investment to one of their funds, which we're planning on making an investment to their infrastructure credit fund. And then there'll be a co-investment directly into switching. So not being a competitor like our IFM and being complementary capital, we're actually coming in on economic terms that are actually more favourable than what IFM managed to access the deal at, notwithstanding that they're putting 2 billion in. We can also see just from a pure sort of transaction multiples perspective that this is at a 27.7 times multiple. It's obviously a very hefty multiple, but is in line with the other transactions that have been done. I think what I've also heard chatting from people that I know at Brookfield is that they were right behind this multiple and actually Switch reached out to them over the course of the weekend when they're about to ink the deal with DigitalBridge and IFM and said, look, do you want to try and beat this? And Brookfield thought that it was more a way of getting them to up their price and actually another live bid. And as such, did nothing over the weekend and the deal got inked on the Monday and missed out. But it's obviously always good to know that there is another big infrastructure equity player out there that was just behind with regards to the multiples of the transaction. When we start looking at Switch and what their sort of plan is here, we can actually sort of see the majority of their revenue is actually coming from Las Vegas, and that's really their spearhead into this market. They've tended to focus on markets where they can get cheap power and labor costs are lower, and it's a good, favorable tax environment. And that's given them a competitive edge. There are these 5 different markets that they are currently in, and the growth plan here is to expand into those markets. You can see that they are obviously a very big player with over 500 megawatts in the space, and their utilization is also very impressive at 91%. Up here, when you start looking at the revenue and the EBITDA numbers, you can see the sort of growth here. And I think what's exciting is also the EBITDA margin here. So we can see that they have been, able to grow that margin. And then what we're going to see is as they build out over the next 5 years, that comes down and the EBITDA numbers stay relatively flat as they take on additional costs, but this revenue continues to grow up. And this is them capturing that market. And then as they capture that market and things stabilize, obviously the EBITDA margin then increases back up to where it was. It's an interesting market. It's, what I would say is a very sticky market with regards to underlying clients, but in a true sort of infrastructure sense, the contract profile is shorter than what you normally see. So the contract profile of the underlying clients that use these data centers is more between the sort of 3 to 7 year kind of range. Having said that, it's historically been proven that they are very sticky and they like to be with one data center provider. So when you capture that market, if you can continue to provide them the growth, then you have those clients for 20, 30 years. And that's really what the story is here, and what we were sort of discussing before about why these companies are being taken private. They're being taken private because they realize that they need to go and grab this extra demand that is going to be there. And they need to do that to grow in the market and keep their dominant positions in the market. When you start looking at this sort of revenue and customer mix, though, it is very diversified, a lot of big names around it. And, obviously this 100% renewable power aspect is very compelling. And a lot of, these organizations have come out and given aspirations around, their renewable targets, and actually using switch because data centers are so energy intensive, being 100% renewable and being the only one in the market that is like that makes a big difference in their competitive marketplace. This is going into, their geographic locations. They have not spread everywhere, and they're not sort of necessarily in the location centers where property prices are expensive, but they are in, very strategic areas. They have the land to be able to expand on those areas. They also have the ability to be able to scale with regards to the renewable power aspect. Back in 2018, they entered into a agreement with Capital Dynamics, for people that are familiar with them, to build out, a 1 gigawatt solar facility. So I think it was a bit over 500 megawatts worth of solar power and 800 megawatts of battery power with using the Tesla mega battery packs. Anecdotally, I've financed those battery deals before. I think from a technology standpoint, they are considered to be one of the market leaders in that space. Also, I think important to people these days is not just the sort of 100% renewable, but also the social aspects, where you can see that they have a very diverse workforce, both from a sort of male to female ratio, but they also do, checks on employee satisfaction. All of those things are very good as well as at a board level, where you can see 7 out of 9 are independent. There are 3 female board members, and that they've had 0 security breaches, which is obviously extremely important in the data center space. And so what we really have here is we have a 100% renewable data center. It's very well positioned in the market space with 2 very big infrastructure equity funds that can sponsor it and drive this growth ambition that they have. There's about $500 million worth of money that is going to go into this company over the next 5 years, being from revenue as well as additional debt financing to fund that growth. But everyone, thinks that this is a very realistic target. And in fact, if you look at their sort of organic growth, they actually turned away 65 megawatts worth of growth last year. And, the CAGR that they've been growing at from a growth perspective, notwithstanding these sort of growth targets, it's actually lower than historically what they have done. And so I think with the equity funding, the fact that they have the land available and have proven that they can do this, this should, be very easy for them to actually execute on. And you can see here the development pipeline, and you can see what sort of current projects that are there, where we have another 200 megawatts worth of capacity coming on. We can see the ones that are actively in development, and then the plant. And so you can actually see here that if this whole plan comes together, it's actually going to more than double in size. And so I think that is very exciting for the company. I think it's a very exciting time for people to be able to get in on this, especially when all these companies are now going to be private. So if you like the space, this is really the last time to be able to actually access this sector of the market in the foreseeable future. Here is just sort of getting into the numbers and where we actually stand on the transaction. So we're setting up 2 product offerings here. One is a levered product offering, and this is really to give people a cash yield alternative to be able to access this. Now, as we've discussed, this is very much a growth story. So the underlying revenues of the switch entity are going back into the business. And so there's not going to be really a cash yield for the next 3 years on that. we have to make an investment into DigitalBridge's funds anyway. And so we're planning on accessing their credit funds. Now, those credit funds are already 20% deployed. The average spread is over 800 and they are floating rate. And so by investing into that fund product, notwithstanding that the Switch Inc. portion of this doesn't have a high cash yield, that fund product does. And so what that allows you to do is it allows you to support a modest amount of back leverage, should you wish. So in this fund scenario, we actually have 25% of the funds being a direct interest into the Switch Inc. transaction. And we have 75% being into the credit fund. And we have 1 turn of leverage being 50% in the background. Now, what that results in is a cash yield of 6.8% out of the gate. Obviously, once the growth plans stop at the Switch Inc. Side of things, that will dramatically increase. And from a net return perspective, we have a total net return of 11.2. And we have a upside net levered return of 15.2. Now, we obviously appreciate that leverage isn't for everyone, but we wanted to give people a current cash yielding option should they so wish.
Peter?
Structure, which is not levered. We also have a nominal investment into the credit fund of $60 million. What that means from a sort of net return perspective is that the total returns are 10.6 net on the base case with an upside of 12.8. The cash yield is obviously pretty nominal here at sort of a 1.4%. This is, I think, a great structure for people that want the unlevered side of things. And I think what's also interesting is the levered fund is actually helping support the main investment into the credit fund because it needs that cash yield to support the debt in the background. And so really what we're offering here is 2 unique fund structures, one levered, one unlevered. It's a good risk profile, I think, on both. And, the investment parameters around that fund offering are very much just that it can do this investment. And so we have a management fee that we are charging. We also have a performance fee over a 8% hurdle to align everyone's interests here. But these partnerships are just being set up to take advantage of this opportunity. So from an investment restrictions perspective, it is very much just that it can invest into the DigitalBridge credit fund, and it can also invest directly into the Switch Inc. transaction. I think it's worth noting that this is a co-investment, and so we are going to get the direct information flow from Switch Inc. Directly. However, if there's no event of default and everything is running fine down at the Switch Inc. level, DigitalBridge will get to vote their shareholdings here. And so from that perspective, we are passive in what is going on. Having said that, I obviously know the folks there very well. And they are already asking for questions and ideas about how they maximize the investments. And so we have a very good collaborative relationship there. So these are the terms. A lot of what we have discussed here today is highly confidential, this being a public company, but we did want to give you as much information as we could. And then post this, should people be interested, we can get NDAs signed up and share much more information. From a timeline perspective, I think that is actually the most challenging part to this whole process. And so we have the presentation today. Should people be interested, they can sign up an NDA and we can provide a lot more information and obviously make ourselves available for one-on-one discussions. We do, however, need to give DigitalBridge a strong verbal commitment, which has to be, yes, we are there for this amount. We still, have some approvals to get in the background, but we have to be very comfortable that, people are going to be there at that point on the 30th of June. Now, from a pure legally sort of signing perspective, we have until the 14th of June. Now, I suspect with current market conditions, maybe there's some room here and this gets pushed out, but it is obviously a very aggressive timeline, but something that we do need to work towards. I think now we can open it up for Q&A, and I'll stop sharing my screen. But please, any questions, please let us know.
Thank you. So Peter, a couple of questions regarding what you just mentioned. So first of all, I wanted to ask you, in the infrastructure space, was there, I mean, how did COVID affect that space in general? I mean, infrastructure is a long-term thing. It shouldn't be, you know, influenced by a crisis or you know, or recession. Even though, of course, it does has its implications. But you know, when you talk about COVID, it's such a crazy phenomenon, and for years, I guess some deals were not done. Some infrastructure was not, you know, continued for a period of time. How did that affect it or not your space?
Yeah, I mean, it's a really good question, Denny, and I'm going to go totally off topic here, but I think that's somehow how we get the most out of these sessions, right? So, look, it's really funny. If I just look at the infrastructure space in general, I feel like I've spent 3/4 of my career wishing I could call it anything but infrastructure, and something more just like real assets or something like that. And now all of a sudden everything is infrastructure, even, you know, like services businesses and things like that that really don't historically at least fall within the infrastructure definition. The reason why this has happened, obviously, is that it now has a great, you know, reputation, and it's been through numerous cycles now. But the underlying contract profile is normally inflation linked. In market downturns, that is obviously, you know, very positive, and they are, you know, monopolistic assets that are needed in society. And so during market downturns, they actually are very stable businesses, especially ironically when they're taken private. And so if I look at sort of a classic example, you know, IFM had a stake in Austrian Airport, and they also had a stake in Manchester Airport Group, which owns Stansted Airport. Now, the Austrian airport traded down about 40% in Q1 of 2020. But when you actually look at the private airport, that went down 10%. Now, you know, I think that sort of shows that, you know, when these companies are taken private, they become far more stable because underlying, you know, owners can look at what the long-term view of this is, but it removes a lot of this sort of volatility. And I should say, you know, in doing this for, you know, well over 15 years now, I've never actually had a principal default on a transaction from a debt perspective. And, you know, all of the equity transactions have actually, you know, performed in line. And I think what, you know, really it comes down to is being able to take a long-term view. And, you know, ironically, the biggest risk to infrastructure ends up being regulatory risk. And I think what people need to be careful of today is really the social pressures and how that affects how governments behave, and whether, you know, that results in a regulatory change that can, you know, impact the values of the underlying assets. And that's actually why, you know, at the moment, I have a bit more of a focus on green infrastructure. Not that this is, you know, you want sort of an ESG strategy as such, but I think it gets you the best outcome and the long-term stable returns that infrastructure is really known for and people want. And so what I would say is, look, notwithstanding, you know, market disruptions that happened in 2020 and COVID, that infrastructure has all bounced back. It has performed very well. The underlying contracts, you know, have continued to escalate. Sometimes on the infrastructure equity side, you will see the cash yield drop down because the distributions aren't there and they want the money for whatever may happen. But you take a long-term view on this stuff and it performs.
Now, going back to the topic, what are some of the key market trends in data centers, collection space? What are you seeing there?
Yeah. And so I think as we sort of
space, sorry.
No, that's okay. So I think as we sort of discussed, the key sort of trend at the moment is going from this in-source to the outsource model. And that really is a scale dynamic that, you know, even though some of these companies are extraordinarily big, you know, this is a scale business, and it is also about sourcing cheap power at the end of the day. And that's why when people start talking about data centers, they start talking about megawatts being power, whereas, you know, one logically would think we should be talking about square footage and how many actual racks you can put in a facility, but it tends not to be that. And so, people are talking about, power. And then I think the real trend is, well, people are setting these renewable targets. And maybe to sort of just go through a few of them, you can sort of look at Facebook that says, by 2030, we want to be, 100% renewable. Apple's in the same spot, as well as Google. Rackspace is a bit of a leader saying 2026. Salesforce ahead of the game, being sort of 2022. Microsoft 2025. But the trend here is, look, over the next, 5 to 10 years, people are looking to get to 100% renewable in the data center space, because people appreciate that this is extraordinarily intensive with regards to that. Now, Switch is the sort of pioneer in that, both with 700 patents of technology to be more efficient around cooling and recycling water, but also by sourcing the renewable power. And I think when you start looking at sort of long-term views on this, and more people will obviously try and trend to be renewable, then in fact you need that edge. And actually sort of doing joint ventures and building out solar arrays is, I think, what is needed to be able to get that demand and actually keep it online in a cost efficient manner. And they've realized that a number of years ago, and are currently building, as I said, this 1 gigawatt solar array already.
Now I have someone here is asking if this is being recorded. So it is being recorded, and we will send you a copy of this session. So you will all get that, including those who showed interest and couldn't make the call. Next question: how does Switch source its renewable power supply, and will that continue?
Yeah, I think I covered that off a little bit before, Denny, but it sources it in the market through sort of long-term power purchase agreements with underlying providers. It also sources at market rates as well, and then has these long-term ambitions to be doing its own solar arrays, which it's currently in the process of doing. And I think just to sort of put that in size, that solar array is 555 megawatts with 800 megawatts of battery storage. So very big facilities. I think, as I mentioned, it's with Capital Dynamics, and that is sort of a well-regarded solar developer as well. And I've actually sort of done numerous deals with them on a direct basis as well. And so I think they're going about this on the right trend. Obviously, Biden using the sort of Defense Power Acts as well, I think is going to help things a lot, because for people that follow the space, it's been a bit challenging to get the solar panels because of tariffs and things of that nature, as well as just logistic changes. And then also there's a potential clawback on tariffs as well for panels that were sourced out of China that people are working through as well. So no issues like that on this project, and I think that is the way forward. Is you have to be able to be almost a solar developer as well when you're doing this.
I see a question here. Even though you're working on the Canadian side of things, if the bill passed by Biden affects you in regards to infrastructure.
Yeah, I mean, I've spent the last 10 years in New York. I think North America dwarfs the Canadian market. So I guess what I would say is to share a personal note is I ended up marrying a Canadian a number of years ago. So I find myself here in Vancouver for family reasons, but notwithstanding that, a lot of my focus still ends up being in North America. So I obviously follow the US market very closely. And if anyone that is sort of interested as well, always happy to have a discussion around green infrastructure, because it's a very interesting space, especially a lot of the sort of technology trends. I mean, what I would say is that, for the money that I'm always looking to raise, I never want to be the sort of first through fourth commercialization of stuff. I'm more the, fourth through 10th, but I think it just depends on, the pools of money you're raising. But at least in my mind, that first through fourth, I follow the technology there very closely, but I think that's sort of more venture capital kind of money. And
again, some of the issues you might have touched during your presentation, but maybe to dive just a little bit more into that. How is the acquisition debt structured? Will recent market volatility impact this?
Yeah, and so what I can say around this is that it is a fully underwritten transaction here. And so what that means is that the acquisition debt here, which is not unsubstantial, has been fully financed by the banks. The banks will be in the market, selling that, but the banks underwrote it at a SOFR plus 250, which I think is sort of a very good terms for this. I mean, quite honestly, the reason why the debt is so cheap here is because of IFM and Digital Bridge and the size of those organizations. I think IFM's equity fund that did this is over 40 billion US at this point. And Digital Bridge is also a very big player in the space. And so when they look to access the capital markets, they can do that on very favorable terms. I think also encouragingly, they also have put in place a facility for the growth plan as well. And so they've basically got a construction facility there with very low utilization fees as well, and very low undrawns. And so, the deal has been packaged up. The recent sort of market turbulence is not affecting the transaction.
And how was this deal really sourced? And what makes this structure so attractive? You were very excited about it from day one when we spoke to you. Why?
Yeah. So, I mean, I'm very excited about this one because it's 100% renewable powered. And I do think that that is the future, and that will allow them to grab greater market share. Even if they just sort of kept on the path of their sort of organic growth, they would still, be in an amazing position. And we are not assuming, in fact, we're haircutting that in the sort of base case returns that we're saying. I do, however, think that there is a lot of upside potential here because of the renewable power side. It's obviously a very exciting transaction for me as well, because I know the people, very well that, led this at IFM. So I've been able to chat to them as well as the guys at Digital Bridge. I think, ironically, I was running a over $1 billion some investment grade infrastructure debt fund in New York until very recently. And the sales guy that helped me launch that product actually went to Digital Bridge. And so, we're in dialogue multiple times a day on this. And that's really how I have the insight running on exactly what is going on and can get sort of more favorable terms than the market. It does become also a bit of a scale game. Look, the more money that we can raise for this, the better we can do for everyone as part of the transaction. And so because you've got to put this money with Digital Bridge and pair that up with the direct investment into Switch, coming through a aggregating fund vehicle like ourselves, and obviously Digital Bridge wants to deal with Agentus, and at the end of the day, they're taking us, at our word on whether the money is there or is not there. That's really what this is about. But aggregating the capital together is the key here, as well as the strong personal relationships that go back near on 10 years.
And finally, what is Switch's competitive advantage really?
Yeah, I mean, I think once again we've touched on a lot of that. I think maybe one that we haven't spoken about is that they have this core cooperative plan. And what that really is they say, look, for all these people that are coming into their data centers, you can actually join this core cooperative, and it allows you to go and actually buy the equipment to put into the data center. And so notwithstanding that a lot of these companies are very big, you put a few of them together and all of a sudden your buying power is exponentially improved. And what that's actually been proving out that is, actually buying the racks and getting them installed, there's actually a 30% saving for these underlying companies compared to doing it themselves. And so I think having that already in place with this trend going from, what was more of an insourced market to what is morphing into an outsourced market, and that additional buying power, especially in sort of logistic chain issues, Switch actually hasn't experienced any of those logistic issues because of their buying power. And so I think that is very much a competitive edge to them, as well as the fact that, they've located themselves in markets that are, low costs of labor, access to the renewable power, have ability to have, the land. And so it's also good that, when we start talking about growth plans and how that's happening, this isn't, hey, you need to go on, buy the plot of land well and then develop it. the land's already there and they already have the space. And so there's no land acquisitions as part of this. It's just development of existing sites in markets where they currently are.
Now, I think I asked you that as well. I see one of the issues being asked is it open for Canadians mostly or only, or, I mean, you guys are in Toronto and Vancouver, the deal is around there.
Yep.
Most of those you approach are in Canada or not necessarily?
Not necessarily. I'd say this is a OECD, outreach that we have been doing. I think we are actually getting a lot of interest out of Singapore, for example, at the moment. I think a lot of people are also looking at this as, look, this could be a great opportunity to do a very large size, and this being the last sort of take private, then be able to syndicate it effectively in the background. So a lot of people have been talking about that, but what I would say is that we are currently contemplating a Delaware partnership as well as an Alberta partnership. If people, have sufficient money and size that makes sense, we can very much, work with people to set up the most efficient structure for them.
Thank you. So these are the questions that I had, and I see that we got from, and we answered the questions from several folks here, and I did send you an email regarding another question that someone had. And this is, as I said, being recorded, so we will send you in 24 hours the recording. And Peter, we haven't seen you in person yet at our Vancouver, Montreal, or Toronto conferences, so hopefully we'll see you there next year. Regarding this the switch deal, anything else that you'd like to mention at this point? Of course, we will send you all your contact information, so obviously you'll know how to reach Peter and the team. But anything else that you'd like to add?
Yeah, look, I think my parting note would just be, look, I think it's, it's obviously exciting to be able to present opportunities like this, and quite honestly to this forum, because being at sort of IFM back in the day, that was all institutional money. And I think, infrastructure historically has been largely, it's large deals, it's, what is considered a sort of hard market to access, I think, for family offices and high net worth individuals. And I really wanted to take the opportunity to see if there was interest here for it, especially seeing that these are take privates, and it's the last sort of opportunity to be able to do that. So, it's exciting to be able to present a good opportunity, and I hope this is of interest to people. I think, just for what it's worth, we slipped into the back end of the deck as well another transaction, if there's any interest there, which is it's actually sort of part of Andrew Fersman's world, where we're doing sort of a AI technology radiograph screening company at the moment, but I didn't want to distract from this one, as well as we're in the market with a green infrastructure co-investment vehicle where, on a go-forward basis, we hope to have the capital lined up to take advantage of these kinds of opportunities. But look, I think it's a very compelling opportunity, and look forward to hopefully chatting to lots of you about it in more detail.
And I think that you mentioned, or maybe we should stress, the deadline is very, very near, which is why, mostly our audience is used to us sending them invitations 2 or 3 weeks before a session. Here, everybody for the first time got an invitation at the last minute, really. So it's important to mention that the reason is there is an opportunity, and the deadline is very, very close, right?
Yeah, that's exactly right. And it's just a nature of the beast, unfortunately, which is also why, ideally you have capital always lined up first. Having said that, we are doing our write-up for our investment committee. I think the write-up is over 100 pages at this point, and they're going to investment committee next week. We also have, draft LPAs ready to go as well. So we're all set and ready to go, and other capital is lined up. But yes, time truly is of the essence here, and apologies for that. It's a great deal, and that I think is actually the most challenging thing about it, is the timing.
And I'm being asked, I see another question, what's the minimum investment in case they missed it?
Yeah. I mean, we have the ability to be able to do up to $1 billion directly into the switch transaction. We're targeting 400 plus, and that's what the sort of numbers in the presentation are based off. If we, for whatever reason, were less than 100 million, we won't launch. But as things are shaping up, I don't foresee that being an issue at all. but we'd be willing to entertain, you know, I think any amounts over sort of $1 million plus. But, you know, having said that, if there's sort of structuring and actual work that needs to be done and you can't come through the existing structures, then that's something that we have to consider whether the cost benefit analysis is there. But I do, you know, as a general rule, want to have this open to everyone, and I fundamentally believe that people should be able to have access to these types of opportunities, and we've got the ability to supply this in scale. So I hope we can make it work for everyone.
Thank you, Peter. And I must say today is an interesting day. You know, we do our sessions. I think we've done over 200 in the last couple of years of these online sessions, which is remarkable, I think. I never thought about that, that we'll reach this number when I started this 2 years ago. But today, I think I had just one other day where I had 2 sessions in the same day. But what's even more interesting is that these are a great Canadian group. So today I have 2 sessions, both with Canadian entities, which is very interesting. So I just wanted to mention that in 1 hour, at 1 EST, which is 1 hour and 10 minutes, I will do our second session of the day with Colliers about opportunities and investment trends in the Canadian commercial real estate world, which is not that far from infrastructure. So very interesting that 2 sessions in the same day, and 2 groups from Canada, which is one of our favorite places in North America. So Peter, thank you so much for being here. We will send your contact info. We will send the recording link to everybody that has registered. And I'm looking forward to seeing you in person, hopefully next year at our in-person Canadian conferences.
That's great. Thank you very much for everyone attending, and appreciate you for setting it up, Denny, at such short notice.
Thank you.
Thank you. Bye.